You have 7. So he assessed you $10,000 because you didn't give records. You were overassessed by $3,000, right?
Yes.
That's what we have to do as auditors, and we do it all the time. It's not that we want to. Okay, if you have the records, we will take your records and use them. All right? Now, how many people, thank you, auditor, you did a good job for me. You have records, we're going to get the records, we're going to actually use your records in order to determine your assessment. If you have really good records, which that was really good records, you have exactly how much sales tax that you're going to owe, we can use that and we can say, okay, you said 7, we're going to look at your sales tax return. Sales tax return says 7, and we say, hey, see you later, we're gone, we're done. Because I don't want to, and my auditors don't want to spend any more time out there than what they actually have to spend out there doing the audits. We don't get paid any more if we stay there longer. We don't get paid any more if we stay there less. We don't get paid any more if we assess you more, and we don't get paid more if we do a no change, or paid less if we do a no change. Now, we do a lot of audits out there. Anybody know how we do audits? How we get your name for an audit? How many people actually been audited, or want to admit they've been audited? I got 1, I got 2, I got 3, I got 4 or 5, coming up close to half of you here. How did we choose you for an audit? Any idea?
Computer pick.
Computer picked?
Yes.
No.
So we got a computer that's just picking out numbers? Kind of a computer pick, but what we do is we look at trends and things that are going on with your business. How many people have gas stations along with your thing? How many report their gas on their DR15s? Anybody report the gas on the DR15s? A lot of our convenience stores report the gas on their DR15s. And what does that do to the taxable ratio when you put the gas on the DR15s?
Non-taxable goes high.
Your non-taxable goes way up.
Yep.
Way up.
One of the things that they look at, the computer looks at, is what is your taxable ratio? As a convenience store, you have any idea what your taxable ratio should be? Yeah, it should be 85 to 95%. What's that?
85 to 95.
85 to 95% should be taxable. Because let's face it, most of what you sell is beer, wine, and soda.
Yes.
Okay, and cigarettes. Beer, wine, soda, cigarettes. ABT stuff. ABT nationally represents about 50% of your sales. I think it's actually 48%, but let's say 50 for this. So what we do is we look at the taxable sales for your convenience stores. And when we look at those taxable sales, we see that your taxable sales are only 30%, you're going to get paid a visit.
Yeah.
When we come out there and we find all your fuel sales are on there, we'll pull out the fuel sales and we'll determine what else you got. And then if that is about 90% of your taxable sales, yeah, then we're going to be pretty comfortable with that. We may just simply say, hey, we're done, we're gone. We may tie some things in to make sure your sales are correct. We're not going to spend a lot of time if your taxable sales are real far up there. But you could avoid the audit to begin with in order by not reporting the gas on there. All right? Another thing that we look for is what is your effective tax rate? When you do, how many do your own tax returns? You do your own tax return? Most of you probably send them out to your accountant to do, right? And what does your accountant do when he does a return? You probably tell him how much tax you collected, and then he'll take that number divided by 6 and come out with taxable sales. He'll take your gross sales, subtract the taxable sale, and that will be exempt sales. Well, that's kind of really off. It's not correct. What you should be doing is giving us the exact amount of sales tax that you collected and the exact taxable sales that you have. And if you actually are doing it correctly, your tax rate should be greater than 6%. If you're in a 6% county, it should be somewhere about 6.38 or something like that. So you keep shaking your head, Jess. You've been through this before, haven't you? Yes. So your taxable sales at 6% should be about 6.38. And at 6.38, that's because we have this thing called a bracket system. Anybody aware of the bracket system?
Yes.
You are? What does that mean?
It's rounding numbers, like you said, $1, then $1 to $2 sales. It goes 0.01, something adds up on 6% basis.
We have a little bracket, and everybody
Bracket
should
system.
have a bracket card, or you should have your computer's program with the bracket system in there.
Yeah,
I thought there was a question there, but he's talking to his neighbor. Anyway, so you need to have your computers programmed with the bracket system. Now, I don't know how sophisticated your computers are,
yeah.
but there's a lot of computers that are not sophisticated enough to get the bracket system in there. I just pulled out this receipt because before I stopped, I got some coffee. And I was just curious, does he do it correctly? He's kind of thing I do as an auditor. I'm always looking at the tax. I get a receipt and I look at the tax. Is the tax correct in here? Well, actually, he's charged me $2.09 for the coffee. How much tax? Who lives in the area? In Rockledge?
Everybody.
Okay, everybody is in here. What's the sales tax rate? 7%.
Yeah.
On a $2.09 sales, how much sales tax do we have?
How much is this?
$2.09.
$2.09?
$2.09.
15 cents.
How much?
15.
15 cents. How do you figure that?
That 9 cents adds 1 penny.
And the 9 cents adds 1 penny?
Yeah.
Actually, between $1 and 9 cents, it does not go up. Okay, so the tax, if you look at the bracket system, it actually should be 14 cents.
14 cents.
And he charged me 15 cents.
So that's-
I didn't complain and ask for my penny back, but it's wrong. But as long as he gives us that penny, we're fine.
Yeah.
Well, how is he going to do this though? He's going to take his gross sales at the end of the month. He's going to subtract off his exempt sales. He says what our taxable sales are, and he takes that and he multiplies it by 6%, and he gives that to us. Is he giving us everything?
No.
No. So when we see a flat 6% on a sales tax return, that's a big flag that says, hey, we probably ought to audit these people, because their rate should be about 6.8, all right, or 6.38. So this guy is doing wrong. I'm probably not going to audit him because of that, because most people can't program their register in order to do the bracket system. So if you can't program it to do the bracket system, how do you figure it? How are you going to program your cash register? If you look in your cash register, you have a choice of either rounding up, rounding down, or rounding even out, or 5-4 rounding. Everybody familiar with that? Nobody?
No.
Look at your register, check your manuals for your register, and see what the rounding is set at. You always want to make sure it's rounding up. If you can't put the bracket system in it, round it up. So when you get to a $2.09 sale, it's going to charge 15 cents. But as long as you give that 15 cents to the Department of Revenue, we're fine. We don't care. If you're overcharging it, overcharge it. We don't care. Just give it to us, okay? If you put something on an invoice that says sales tax, you got to give it to us. I've had people out there that are charging 7%, and they're in a 6% county, and their sales tax returns show 6%. They don't know any better. They don't know what their register is actually doing. You know, they don't know it's charged 7%. Actually, what had happened is this guy was in a 7% county. His register was programmed by the guy that set it up for him. He moved from a 7% county into a 6% county, still used the same cash register, never thought to change on the tax. So he started charging 7%. He took his taxable sales, multiplied it by 6%, and gave it to us. He's 1% off. Sizable number, right? So that's another way we pick up audits, is through that. Everybody familiar with ABT? Alcohol, tobacco, and beverage? All right, we get records from everybody that's supplying you with your alcohol and tobacco products. Okay, we get a report from them once a year. We take that report and we pull it all and we organize it, and we take a look and compare that report to what your actual sales are. If there's a big discrepancy, then you're probably going to get a little love letter from us. We've actually had some taxpayers out there, we've pulled the ABT information, and for 1 year, they have purchased more, or actually twice as much ABT products than what they totally reported as their total gross sales. You think that's a problem? You got a big problem. You think it might be criminal? Yeah, it might be criminal. In fact, we had one person that had 4 times as much purchase of ABT products than they reported to us as sale. It went over to our criminal department really, really fast. Those that are like 1.5 to 2 times as much, they may go to our campaigns people. So from our campaigns people up in Tallahassee that do desk audits, they will send you a nice little love letter and say, hey, we think you owe this amount of money, prove us wrong. And if you have no records, you can't prove wrong, right? Again, back to our records, you have to have good records. So we have ABT records that we also use in order to determine who's going to get audited. Okay, we don't really have anybody that we really do randomly. A lot of times your auditor is going to tell you, well, we picked you up randomly. Well, we really don't. Usually before we come out, we really have a reason to come out and audit you. If we pick up people randomly, it's a waste of our time to go out and to see them. If we already know there's an issue, we can go out there and either educate you, assess you, give you no change letter, whatever it is. Every audit is not a bad thing. An audit can teach you what is and what is not taxable. okay? Your audit could end up to be a no change. It could end up being a refund. We actually have some audits that come out to be refunds. And then some of them turn out to where you have to actually pay us your tuition for your education. So we will educate you and you have to pay our assessment when we get done with that. Now, record keeping, how to avoid an assessment. If you have good records, you can minimize your assessment or totally eliminate the assessment. How many people have scanning systems in your business? I got maybe half of you, a little more than half. Do you use your scanning system appropriately?
Yes.
Okay? You say yes. Okay. If you have a scanning system, what does it tell me as an auditor? It tells me exactly what you sold. It can tell me when you sold it. It can tell me how many of that item you sold and how much tax you actually collected on all that stuff. That's perfect records like what you have here. Right? You can say, hey, here's how much I can compare that with the DR-15s and see that it's exactly right. When you get your product in the door with a scanning system, you can scan that product right in inventory. When you scan it out of inventory, it goes out. Right? You have good internal controls over your products coming in and out. What happens if you don't have good internal controls over your products coming in and out? You got the guy at the cash register. This is mom and pop shops. This is a good thing. They got a cash register up there. They don't have a scanning system. The guy's up there. He's got his pimply face. He's a teenager boy. This is his first job, and he's really happy with the first job. And so when his friends come in, his buddy comes in there. He's got his six-pack of Coke sitting up there. He knows that he's got a camera. The guy's watching that he's got to ring something up. So he rings it up, but instead of ringing it up for how much is a case of Coke or 12-pack of Coke? Huh? $4.95. Okay.
$4.90.
He's supposed to ring it up at $4.95. So he hits that little button up there and he rings it up as grocery. Okay? But instead of at $4.95, he rings it up as 10 cents. Right? He just gave away that 6-pack or 12-pack or whatever of Coke. He just gave it away. Right? What happens to your bottom line? You're losing money. Is there any control over that? If you had that scanning, you're scanning it, it goes right into the register. Now he has to get that amount of money. Because at the end of the night, somebody's going to count that cash drawer and make sure you got a cash control to make sure it's correct. So his buddy's not there. He's got this really, really cute girl comes in. Okay? Teenage boys like cute girls, right?
Yeah.
So what is he going to do with a cute girl? We'll see each other later, okay? You just take it out, you know. Just pushes it under the counter. You can keep away from a lot of that. Or with your people up at the counter, do they know what's taxable and what's not taxable? They don't. Do you know everything that's taxable and not taxable?
90%.
You know 90%? Well, that's good. I gave you guys a little thing, DR46NT. That's the list of the non-taxable items. If it's on that list, you can not tax that. All right? But, what's that? You guys didn't get one?
No.
Push it on that.
Yeah, that's it. That is all right.
You need one?
Are you paying?
There's also this one you guys can get.
That's the
Expect
one.
them on. All right. You got that guy sitting at the counter, and he has no idea what's taxable or not. But you as the owner of the store, you know what's taxable. You know 90% of what's taxable. When you have a scanning system, you can set what is taxable and what is not in the main database to say what you're going to tax and what you're not. The guy at the cash register has no control over that. He can't do anything but tax it. I went down, I got these glasses, I just got them repaired, and there's a service warranty on them. I had to pay $25 for the service warranty in order to get them fixed, and then I scratched them again, so I got to go back and fix them again. But they charged me tax on the service warranty. Well, I don't know if you guys know anything, but service warranties are not taxable.
Yeah.
And so I'm telling LensCraft, you can't charge me tax on that. That's not taxable. She says, well, our system doesn't. We can't take it out of the system. Well, same thing with your scanning system. Once you put it in there, you don't let anybody change it. If anybody wants to change the tax on there, you have to change the tax. So the person at LensCrafter could not change that. You know how I had to get my tax? Well, I never did get my tax back. But from that, I had to go over to LensCrafter and say, hey, look, you charge tax on there. You're not supposed to charge tax on it, right? discipline out of their system is such that they don't charge tax on it. So if you go in the LensCrafter, you got a service warrant, have to pay that 25 bucks, they shouldn't be charging you tax on it anymore. But anyway, it's an internal control. They have good internal controls. You guys need to have good internal controls in order to save yourself money. And that's good record keeping. If you have a good scanning system, that's good record keeping, that's going to be beneficial to you in the long run. Now, those people that don't have scanning systems, how do you know what is being taxed and what is not being taxed? Who does not have a scanning system? Come on, somebody doesn't. Everybody's got a scanning system? Yeah. Come on, admit it. Okay, you don't have a scanning system?
Well, I didn't before.
You've done it before?
No, before I did not have it.
Oh, before you did not have it, okay. How did you determine, or how did the guy at the register determine what was taxable or not?
Yes.
General knowledge, water.
Yes.
He kind of guessed.
Guess.
Okay? When you put it in the register, how does it get in the register whether it's taxable or not? You hit a tax key. Or you may hit cigarettes, and the cigarettes are always taxed. Or you hit non-grocery, and it's always taxed, something like that. So it's a matter of making sure you hit the right key. As an auditor, when I go in and take a look at that, I have to know exactly how much tax you've collected, and that you're collecting tax on the proper things. If you're not collecting tax on the proper things, then I have to make an assessment. So how do I know, by looking at your Z-tapes or your detailed Z-tapes, how do I know what you sold? I don't know. There's no control. If you have a scanning system of some kind, and you're working with it properly, I know exactly what you sold. Because on it, like this receipt says, co-op hot, the co-op, or is that Dunkin' Donuts? Anyway, let's see. 1 DT cup of hot coffee, 20 ounce. It tells me exactly what I'm getting there, okay? I go on and do the audit of this. Oh, you sold a 20 ounce cup of coffee and you charge tax on it, very good. I can also look at a scanning system and say, oh, you sold a candy cane and you didn't charge tax on that candy cane. Your system is not charging tax on candy cane. Well, that's a problem, right? Candy canes are taxable. So I can basically say, okay, from your system, I want you to give me all the candy canes you sold. Some of the people have scanning system, but you don't buy the background software for it. The backroom software, the software that basically can give the auditor all your sales, can give your auditor your scan code list to show everything that you're scanning and whether you taxed it or not. If you, do you know, I have a rule in my classes when we do our class. We have a rule when we do our classes. If your phone goes off during the class, you get to dance the ringtone. I won't make you dance. I was up there one time and my phone went off because a buddy that teaches with me, he turned it on and I didn't know it. It went off, so I had to dance to it. This boy can't dance. So it's not a pretty sight. So I make sure mine's off all the time. But anyway, get the backroom software that goes with these scan software that you get. That way you can get a better control of your inventory, you can get a better control of what is taxed and what is not taxed. What you're setting up in your system is being taxed. I had somebody that was taxing water. Is water taxable?
No.
Pure water is not taxable, so you should not be taxing it. If you tax it by mistake, you got to send that money into the state. Because like I said, if you're collecting tax, you got to send it in. Once you collect tax, that becomes state funds at the moment of collecting it. If you don't send it in, it's theft. All right? She's laughing back there. You think that's funny?
Yeah, it was happened one time. My daughter told that man, seriously, you charging tax on that? And then he took it out.
Yeah, don't tax things that no. We don't want any more tax than what's supposed to. And that's why we try and encourage you to get a good accounting system. Get the scan records, get the backroom software, so when the auditor comes in there, he can take a look at that scan code list. And through that scan code listing, say, okay, this is taxable, this is taxable, this is not taxable, this is not taxable. You've got this all wrong, all correct. Okay, this one you have wrong. Now, you can fix that for the future. All right, and now everything's great. We can identify exactly what's wrong, whether you're taxing something you shouldn't or you're not taxing something that you should. We can fix that. A lot of companies, before you had the scan system, you just rang stuff through and you tried to make sure the guy at the cash register was ringing the correct stuff through. When we get those kind of situations, what we have to do is we have to rebuild into what are the sales. And hopefully you guys have got some kind of records that we can use. And what we're looking for is the purchase records. Because if you purchase something, you probably sold it, correct? unless it walks out the door. And if it walks out the door, we can shelf study. We're going to determine how much stuff is on the shelf, what are you selling it for, and what did you pay for it on a current basis. And we're going to figure out what the markup is. And what we're going to do is organize those by industry standards. The C-store has certain categories for different type of products. We usually assemble things in those same type of categories. We also have what the National C-store markups are. And we look to see if we can't do a shelf study, we're going to use those national ones because, like I said, we're going to use the best available information we can get. So if we can't do a shelf study because you won't let the auditor into your premise for some reason, we've had some taxpayers say, oh, you can't come into my store, you can't see my records. Well, in those cases, we can't do a shelf study. All right? Allow the auditor to do his job. Let him come in there and take a look at your store. Let him walk around and see what you're selling, what you're not selling. That way he can make some good judgment calls on what to pick up and what not to, how to build his assessment. So he's going to take your purchase records, he's going to do that shelf study, he's going to schedule in things that should be taxed and things that should not be taxed. Or if he does a walkthrough with you, and which most auditors should do, they should walk through with you and say, especially if you don't have a scan system, and say, hey, what are you taxing? And you're going to walk around, you're going to point at the different things you're taxing. You're going to go over to the drink cooler and you have all these juices in there. You've got Minute Maid lemonade, you have fruit juice, you've got juicy juice in there, you got orange juice in there. You know, I was totally shocked because I'm not one to buy a lot of juices. I don't have kids anymore. So I spent one day in the juice aisle of a grocery store to try and determine what's really taxable here and what's not taxable. How much is taxable, how much is not? How much of juice do you think is taxable?
Less than 100%.
Well, anything is less than 100%. But of the juice products that you see out there, most of them are going to be taxable. And I was shocked because if you have a juice, unless it's 100% juice, it's going to be taxable. So if it's called a drink, it's called an aid, it's called a blend, or any of those fancy words they add onto it, it has to say it's juice, 100% juice. If it doesn't say it's 100% juice, it's going to be subject to tax. And I'm surprised about how many of those products are actually taxable. But a lot of the people out there think, oh, it's a juice. It says it contains 100% fruit juice or made with 100% fruit concentrate. Well, yeah, it's made with that, but it's got a lot of sugar in there. All right, it's got a lot of things in there that you don't expect it. In fact, I use in my class cran grape juice. Cran grape juice. Have you ever taken a look at the label of a cran grape juice? Or cranberry, well actually cran grape drink is what it is. It's made with 100% cranberry juice and made with 100% grape juice. So the cran grape there that you're looking at, you're thinking, oh, this is going to be good and healthy for me. Oh, look at the label, it's mostly sugar. You know the #1 juice in?
Orange juice.
Huh?
Orange juice.
No, apple juice.
Apple juice.
Yeah, apple juice is the main one. There's no apple on the label. It says cranberry grape. No word. But most of these juices are made with apple. They're a blend of some, and most of them are going to be taxable. It's when you got pure orange juice or pure apple juice, and it's labeled 100% juice, is it going to be exempt. But these are things that we look for when we take you around, and we're going to ask you what's taxable or not. Now, if you're saying that you're taxing all the orange juice and you're taxing all the water, when our auditor does their markup study, they're going to add that in there as taxable items. So your taxable rate is going to go up. Now, he's going to tell you from the future, don't tax the water. Don't tax the 100% juice, the orange juice, the apple juice. He's going to tell you that. All right, but he only knows that because he's had a conversation with you. Anybody still sell phone cards? Nobody? I got a couple that still phone. You charge a tax on your phone cards?
Yes.
You are, okay, very good. We had trouble one time that people weren't charging tax on phone cards. In fact, I had a business right next door to where I was working, and I walked over, I got complaints from another business close, and he says, hey, look, this guy down the street, his little convenience store, he's not charging tax on his phone cards. He says, I can't compete with that. You're talking 6%, that's probably your profit on one of these things, right? So I walked over, knocked on the door, and I says, hey, look, I'm here, I'm from the Department of Revenue, handed my business card, and I said, I'd like to speak with the owner, because we always want to speak to the owner. Well, the owner's not here. Okay, well, I need to see your sales tax registration, because you all know you have to have your sales tax registration posted. You know, all your stores make sure it's posted for anybody to see when they walk in the door. So I asked him for the sales tax registration. And he says, well, 1 minute, I keep it under here. I said, what do you mean, you keep it under here? Yeah, it's the owner talking to me, right? The owner's not there, and now he's here, right? I said, the only reason I stopped by is because I got a complaint that you're not charging tax on your phone card. And he said, well, are those taxable? I said, yes, they are taxable. And he didn't know. You know, a lot of people don't know. There's things that people don't know. So I go out there and I educate him. And I said, what you need to do is, here's my business card. What I want you to do is do a self-disclosure. Go out and find out all the business or all the phone cards you sold. All right? And then send that over to me, and that's what your assessment will be, is whatever phone cards you sold. Everything you purchased basically is what you sold. So I wait for a couple weeks. Don't hear another word from him. Give him a little call up, and I says, hey, where's this? Oh, we'll get it here in another few days. Waited a few days, a few weeks, never got them to me. So this guy never did send them. So what do I have to do? Send him a love letter. He gets that nice little love letter. Well, he had no records. So what do? We chose the 10. So now we got a $30,000 or $50,000 assessment against the guy, and he's complaining because we're assessing $50,000. You got no records. That's the only thing we can do. Save yourself some problems. Keep your records. He had no purchase records whatsoever. He had no sales records whatsoever, or at least he didn't provide them to us. A lot of taxpayers simply don't provide us records because they think they're better off if they don't. You're always better off if you give the records. Like your little thing there, you give me the $7 or $7, that's all we're going to get from you because we have the exact records. But if you don't have records, we don't do anything, but we pick the 10. Now, we try and go and get your purchase records. We're going to pick an inventory cycle, and through the inventory cycle, we're going to rebuild into what your sales should have been. Now, anytime we're going for purchases up to sales, how accurate are we going to be? It's not going to be all that accurate. Okay, it's going to be somewhat accurate, but it's the best available information we have. So we're making an estimate based upon the best available information. That's what we're going to do. Now, if you got no records, we take ABT. We got the ABT records now that most of you guys are selling either cigarettes or tobacco, right? Or you're selling both, and you're selling a lot of it. History says from what we get from the C stores is about 50% of your sales is going to be ABT. So we have some industry standards of what the markup should be. So we hit the beverage sales, ABT sales, we hit it by that markup. That's what your gross sales are. 85% should be taxable sales. We multiply that by 80%, that's your taxable sales. Sales tax rate should be 6.38%. So we're going to hit it by 6.38. Now we're going to compare that to what you gave us on your return. If you gave us less on your return, we're going to assess you the difference. It's going to be like a $50,000, it could be $30,000 to $50,000 assessment, which is not unusual for the C stores out there. So, are records important? Is having a good scanning system important so that you can show us exactly? It's very important, and it's very valuable for you. I talked to some people at the show that were convenience store people, and one of the things we asked them, I said, you guys have a scanning system? Well, I can't afford a scanning system. You really cannot, you can't not afford it, because if you don't have it, you're going to be one of those people that's going to sit there with a $50,000 assessment and you can't prove it wrong. Because what the auditor says is your assessment is correct. It's prima facie correct. In other words, the court says that is the correct. And I have been through a few court cases where I've had to make assessments based on estimates. And when it goes before the judge says, show me a record to show me that the auditor was wrong. Taxpayer says, I can't. You owe the money. End of story. Because it is correct unless you've got the records to show it wrong. So, records are important. It can save you a lot of money. It can save you better on your bottom line for controlling your inventory. Making sure that guy doesn't get all flustered with that girl walking through the door. Okay? He makes sure he scans everything and gets the right amount. Things that are taxable end up being taxable because you scan, or that you put it in the system correctly. If I, is that mine? Well, that's my alarm, so I gotta be done, I guess. So, anyway, that's basically what I wanted to talk to you about records. You got any questions about any of that, about the records?
How many years the record should be kept?
How many years should the records be kept? Well, standard procedures is we can only make an assessment for 3 years back, provided that you filed a return. So the statute of limitation is 3 years on any filed return. If you failed to file a return, or you file one that's grossly false, we can go back further. We can go back forever if you never filed a return, or if you failed to pay a return. So sometimes you may get a 3-year assessment and the auditor may come out there and says, oh, you didn't pay that return 5 years ago? We're picking that up in the audit. Now, he can only pull that 1 year in the return, he can't pull everything in between there, but he can actually extend that back. I've actually done some audits that gone back to 1985. Not sales taxes or other taxes, but we can go back as far as 1985 to make an assessment. Any return due on or after June or July 1st of 1985 for sales tax. So we can go that far back. But normally, it's a 3-year assessment period, so we can only go back 3 years. I would recommend you keep about 4 years worth of records. All right?
Thank you.
But it has to be in the premises or?
Thank you.
we can
What's
keep
that?
The record has to be in the premises or we can keep it at home?
You can keep your records wherever you want, just so when the taxpayer requests them, you provide them in a timely fashion to him, okay? Or have him have access to them. Now, you won't necessarily have to bring them in your store if you have a different place where he can access them, whether it be your accountant's office or being maybe at your home, depending on how your home's situated and where it's located and so forth. If the auditor is comfortable coming to your home, sometimes we do audits at home. A lot of times, some auditors are not comfortable with that because of personal security reasons, and I think you can understand that. But if the auditor's comfortable with it, you could ask him if you'd like to come out to do it there. We can do it there. If the auditor requests them to be at your business location, he can mandate you provide them at your business location, all right? If you provide them at your accountant's office, that's just the same as doing it at your business location. Now, a lot of people, as soon as they get that A40, they go out and they hire an attorney right away, or they hire an accountant right away to take care of it. One of the problems I see with that, now, I don't want to discourage you from getting an accountant involved, but what happens with an accountant? Anybody play telephone when you're a kid and you tell somebody something, they tell somebody something, then it goes all the way down the line. By the time it gets to the end, it's not what you asked, right? An auditor will ask the accountant something. The accountant will go back and ask you something. You turn around and you ask the bookkeeper something. That bookkeeper has to go to the accounts payable person. By the time it gets back around, it's not what the auditor wanted. If the auditor is right there at your business premises, talking directly to you, you can hand it to him and say, hey, is this what you're looking for? Auditor says, yeah, that's right. Or you can say, no, that's not really wanted. What I'm really looking for is this. It will speed your audits up and make them a lot more accurate. I find that when CPAs are involved or accountants are involved and they get in the middle of some of these things, the communication lines are not as good. And your auditor is not going to come out there, at least he should not be, coming out there trying to get you. He's out there to educate you and to find out if you're doing things correctly. If you're not doing things correctly, he's supposed to educate you and get you doing things correctly. That's whether you're taxing something you shouldn't be taxing or not taxing something that you should be. Not reporting things on your return you should report on a return, or reporting stuff on there you shouldn't be reporting, like the fuel sales. Don't put your fuel sales on there. It's just a flag for audit. Any other questions on records? Come on, somebody's got to have something. No, you're just going to scratch.
Fine.
Any other questions about sales tax? Nobody's got any questions on sales tax?
Yes, I do.
Yes, go ahead.
Dietary supplementary.
Dietary supplements.
Is it allowed to sell on EBT? Especially 5 hours energy.
Okay, I cannot tell you what is eligible for EBT
Commissioner.
because that is not my venue.
Okay.
But what I do know about EBT is anything that's edible can be purchased with EBT, which basically, unless it's hot food or prepared on the premises, or it's alcohol, if you can consume it, we treat that as eligible for EBT, and that's what we do with the Department of Revenue. And from my experience of what I read, that's pretty much consistent. So I can't tell you specifically, but I can tell you what we do. Because that's more of a federal question to ask.
Okay.
So I kind of tapped
Second
answer around
question,
it.
you were saying it while saying like six-tour markup, you have a national database.
Yes.
As for my knowledge, all the database is reported by all big corporate chains or something like that. And they have always better margins than like independent owners. So their margin is always lower than what the chain stores and supermarket, they are do that.
Yes.
So that's the reason they penalize more
But you're not
because
really,
they works on a low margin.
we don't look at it as being penalized.
Okay.
It's a matter of, if you have no records, that's the best we can do.
No, record is fine, I'm just.
If
yeah.
you have records, then we can work with your record.
Okay.
And we can get something accurate, or
I see.
more accurate than if you don't have records. If you don't have records, we're going with the national averages.
Okay.
And yes, those national averages are a bit skewed,
Yeah.
okay? Because there's more skewed to your national store chains and that kind of stuff.
Exactly.
Right? Which your margins, your markups may be way different,
Right,
all right? And we understand that.
okay.
But we're frustrated from the fact is, if you got no records, we can't do anything for you. I would just as soon go out there and tell the taxpayer, you only owe me $1,000. In fact, if I'm out there doing an audit and found you only owe $1,000, I'm probably walking out. I'm not even getting to the point of saying you owe $1,000. I'm just saying that's a no change. Because it's not worth my time to do an audit assessment of $1,000. I would just as soon get you doing stuff right. In fact, I go out there and I visit stores all the time, and like LensCrafters, when I went in there, I educated them to what they were doing is wrong. And I'm constantly doing that. I drive my wife nuts when I do that. I'll say, hey manager, I need to see you for a second. You got that video machine over there? I need to see your permit for that. You don't have a permit? You know there's a penalty for that? Anybody got amusement machines in their businesses? No more amusement machines? You got an amusement machine? Do you have a contract for your amusement machine?
No, I just use the radio.
You what?
Radio.
The
Only
radio?
the radio station.
No,
Sorry, yeah.
Music machine.
Oh, no music machine, no.
Amusement machine.
Oh, no,
A
no.
Like
pinball
game
machine.
machines
a
like
Oh, no.
gaming
Gaming machine.
No, no.
Game machines like that.
Sorry, yeah.
Gambling
Yeah,
Gambling
no.
was basically.
Well, if it's a gambling machine, you don't want it in there. And the difference between a gambling machine and not a gambling machine is that a gambling machine is totally by chance, all right? A amusement machine is one that takes skill in order to win. Now, some of these card machines out there, they have established that those are not gambling machines because if you've got enough skills and you tap it just the right way, you can win all the time. Okay? I'm never that good. Right? But amusement machines, some convenience stores out there have amusement machines. Amusement machines is a big problem area. Besides convenience stores being a problem area, and why we're addressing them, is amusement machines is also a problem area. Where the store owner doesn't know what his liability is. Do you know what liability is if somebody comes out there and says, hey, look, I'll put an amusement machine in your store and we're going to get a 50-50 split. You're going to get 50% of the proceeds out of the machine. What's your responsibility?
Sales tax.
Sales tax on what?
On the total revenue.
The total revenue.
Yes.
So everything that comes out of that machine, 100% is that's your responsibility. Yes, you are correct. You've had a vending machine or amusement machine in your premises, haven't you?
Never.
No? You won't do it anyway.
Never.
Amusement machines, if you have somebody put it on your premises, you owe the tax on 100% of the gross proceeds that comes out of that machine. So when he gives you $100, because that machine's on your premises, he's giving you $100, and he's keeping $100, he's got to get $106 from you because you get $100 for renting the machine and the $6 of tax that he's going to get. You have to pay the state of Florida the tax on the $200 that came out of that machine, even though you never counted the money coming out of the machine. You have no idea how much coming out of the machine, other than the fact that you got $100. So you have to assume it's 50-50 split, so the other was $200 is total. So you owe the tax of the $200. If you get an amusement machine, the location owner is always going to be responsible for the tax. The location owner is also responsible for displaying a permit that machine can be there. Now the permit's $30 a year, right? What happens if you don't display the permit?
It's fine.
You know?
Fine.
A fine. How much is the fine?
I have no idea. I never had a fix, so I don't know.
$250. $250 per machine. So if you have an operating machine on your premises, $250 for that. There is no cap to that penalty. So if I walk in today and you don't have your sign up that shows your little permit, I can hit you $250 penalty. Okay, another person from the Department of Revenue walks in there and says, hey, I don't see a sign up there. Kurt was just in there the other day and you haven't gotten your permit yet? It takes 2 seconds to get online and do it, or call up the department and get your permit right away. Why didn't you do it? Well, I don't think Kurt knew what he's talking about, so I didn't do it. Well, Kurt knew what he's talking about. Here's another penalty, $250 in that machine. You still don't believe that guy, so you just don't do it. Third guy comes walking in and he says, hey, look, you're supposed to have your sign up here. I see in my notes that you've been told twice about this. He can hit you with another $250 penalty. So there is no cap on that penalty. Like sales tax and penalty on sales tax caps out at 50%. But the penalty for not getting a permit is $250. Now that's if you don't have it displayed. You're the operator of that amusement machine. You're the one that's responsible for getting it. You're the one that's responsible for getting that. So if you don't buy the permit, there's a $250 penalty for not buying that permit. One for not displaying, one is the operator for not getting the permit. How much is that penalty?
500.
$500, exactly, you can add well. You need on that, the person that owns that machine, what you're getting is rental of the space. So that's going to be taxed as a commercial rental. So your consideration that you're getting off it, because it's not an amusement machine,
Right.
except it can be amusing to see some people operate these things, but it's not an amusement machine, it's a vending machine, and so all you owe is a tax on the gross proceeds that you're receiving. So when he gives you $100 for that
You
machine,
pay the tax on that.
you should collect $106 from him. Not just the $100, but the $106, because he has to pay you 6% of the proceeds coming out of it, or whatever the tax rate is for your account. Now, starting January 1st of this next year, the rate goes to, I think, 5.8% for commercial rental. They're kind of simplifying the tax law, right? So, it's no longer 6%, it's going to 5.8% for commercial rental. So if you get something, a percent off of that, you will probably pay 6 or 5.8% plus whatever your local option rate is. All right? Any other question about sales tax? I'm here to answer anything and everything about sales tax. Whether it's about audits, whether it's about convenience stores, what is taxable, what is not taxable. You mentioned something about the 5-hour energy.
On EBT.
Okay. This one, Ramesh bhai.
EBT, but a lot of people don't think the
Because
5-hour
we have
energy.
like when we sell, somebody argue, oh, these two don't charge the tax on this, on EBT, like
No.
on that, like that.
Ramesh bhai.
5-hour
Okay.
energy,
Anything
if you look
is
at
a
5-hour
supplements,
energy, you'll see a little line on the bottom of it, it says it's food supplement, okay? Because it's a food supplement, it's exempt from sales tax. So whether it's EBT or not, I don't care, it's exempt to begin with, all right? So we don't get taxed on that. And yes, people don't charge tax on it properly. I bought one as an illustration for our class. I went out to out to Winn-Dixie and bought a 5-hour energy. I thought this would be nice, just an example for my class to say, okay, is this taxable or is it not? Because we do a lot of that. We get a lot of different products and we'll hand them out to the classroom, let them decide whether it's taxable or not, and have a discussion on why it's taxable or why it's not taxable. So one of the things I got was a 5-hour energy. And of course, I pick up the receipt and I look at the receipt and say, oh,
Tax.
they taxed it. They shouldn't be taxing this. Okay, I go out to Publix and I can buy 5-hour energy there, and I don't think they tax it there. So just because somebody is a big store, like a Walmart or a Winn-Dixie or a Publix, don't trust them as your source of what is taxable or not. If you ever want to know if something's taxable or not, you've got the DR46NT, okay? Use it, refer to it. Now, exemptions are narrowly construed against the taxpayer, so they're narrowly construed against you. So if there's any question of whether it fits on this list, tax it, okay? You always want to err to the side of taxing it, because exemptions are narrowly construed. So if you're not quite should be taxed or not, this little thing about audits that I handed out, what do I do if I encounter a problem during the audit? On that, about the middle of the page. Got taxpayers' right advocate, and if I, oh, actually, that's not what I'm looking for. Where is it? Oh, second page, middle of the page. Can I request technical assistance advisement during an audit? Okay, right here, middle of page 2. I was looking at middle of page 3. Middle of page 2. If you look at that, that gives you the address to write to if you have a question about a product. So if you have a water that comes out, and you look at it, and the water has to be 100% water. And I'm looking at this one. Let's see, what does this have? Ingredients: purified water, calcium chloride, sodium bicarbonate. Well, that's not pure water, is it? So is that taxable or not?
Non-taxable.
Why? It's supposed to be water. This is exempt, right? Well, that's not water. It's got added to it, right?
It's still natural.
What?
It's still water.
It's still water?
Yeah.
It's no chemicals.
It's no chemicals. I just read off there calcium chloride. Is calcium chloride not a chemical? Chloride's a chemical? I'm looking at sodium bicarbonate. Isn't that a chemical? So you may read the labels on here and say, well, that's really not water. Is it taxable or not? You can write for technical assistance. No, it is exempt because there's a special provision that was put in the statute for water for the bottling plants so that they can,
Bacteria prevention.
well, it's not necessarily for bacteria prevention. It's to improve the taste. Okay? I don't like bottled water. From the standpoint, bottled water takes on the flavor of the plastic. In order to avoid that, they put bicarbonate, sodium bicarbonate in there and these different additives in order to neutralize some of those flavors, or so they can still sell it as water. So as long as the flavorings are put in, or these different things are put in the bottling plant, the processing plant, we can still sell it as water. If they have anything that's a flavoring, such as it's a strawberry flavored water, it's going to be taxable. I'm trying to think, Smart Water. You guys familiar with Smart Water? Yeah. Some of those, so you got strawberry flavored Smart Water, you got different types of Smart Waters. There's one that's just purely nothing more than vitamins and minerals added to it. If it's just vitamins and minerals with no other flavor to it, that is still going to be an exempt item. Okay, so you can still have minerals added to it and still be exempt. But as soon as they add flavor to make it taste like strawberries, make it taste like bananas or kiwi or whatever you want, now it becomes taxable. All right? Anything else we got?
How about the bread?
How about the bread?
Non-taxable.
What about bread?
It's taxable?
No.
What's on your list there?
Where is it taxable?
It says bread is taxable?
Yes,
That list is non-taxable items.
Non-taxable item.
So if you see it on there, it's non-taxable. You got it? This is the non-taxable list. This is not the taxable list.
What about milk and the small milk with
Milk.
the sugar?
Milk,
Well, yeah.
if it's milk, creamers, milk products, things that you're going to mix with coffee, little creamer milks,
Right.
all that kind of stuff is going to be exempt.
What about chocolate milk?
Chocolate milk is going to be exempt. Your cans of Starbucks coffee drinks
Right.
that are sealed containers, we treat those as exempt.
So all Starbucks is non-taxable?
I wouldn't say all Starbucks is.
Can.
Because Starbucks sells a whole lot of different products. If it's basically a coffee mix, okay?
What is the chocolate flavor, different flavor there?
Okay, we have different flavors in there, but if it's a basic chocolate or a basic coffee mix, we're treating that as exempt. This is only through a letter of tech advice that we sent out to a few businesses out there. When you get to these products and you're not sure, write for your own technical assistance advisement, something to protect yourself. If we really look at the technical thing about sales tax and what is a soft drink and what is not, there's really questions on whether or not the Starbucks would be taxable. But we've had somebody in Tallahassee make the determination that the Starbucks drinks are coffee or coffee-like, and so we're exempting them. But you know what Yoo-Hoo is, right?
Yeah.
Everybody's familiar with Yoo-Hoo? That's a soft drink, and we tax it.
Yes.
Okay, and hopefully most people will tax it. And he's sitting back there, what's the difference? That's my,
Chocolate milk and
that's my same question. Well, the biggest difference between Yoo-Hoo and chocolate milk is Yoo-Hoo is made with milk derivatives. So it's made with whey and all this other stuff in order to make the Yoo-Hoo. Whereas chocolate milk is just milk with chocolate flavoring in it.
chocolate and sugar, two product there.
Yeah, or strawberry milk, the same thing. It's got sugar and flavors added to milk. So they're basic milk products. They're not milk derivative products.
What about
That's-
ice cream?
What about ice cream?
Yeah.
Taxable.
Ice cream is going to be exempt unless it's a pint or smaller. If it's a pint or smaller, it's considered a novelty item.
Novelty item.
And as a novelty item, it's going to be subject to tax, which includes any frozen yogurt or any frozen ice cream. If it is a pint or less, it's taxable. If it's over a pint, then it's going to be exempt. I went out and my wife loves these little things of, who's that real famous ice cream
Haagen-Dazs.
person? What?
Haagen-Dazs.
Haagen-Dazs, yeah.
Haagen-Dazs.
But she loves Haagen-Dazs ice cream, the rum raisin. That's her favorite. So we went in to get Haagen-Dazs ice cream for her one day. I looked at 1 pint, 0.1 ounce. I said, they know our sales tax law or what? Because it's just slightly over a pint, so therefore it's going to be exempt. But last time I checked Haagen-Dazs, it is a pint, so now it's taxable. But that's your ice cream. What else we got?
Well, I prove myself and I'm doing non-taxable at the end of the day, 4% or 5%. Now I come to know a lot of stuff are non-taxable. On the next month, if I do my sales tax return, it's going to be 10% or 11%. Is there any question for they will ask me?
Well, we're not going to question so much changes in your return as long as you can support your changes. Okay, so you have a scanning system?
Yes,
Go to your scanning system, make those changes.
right.
And you want to make sure you have a history of those changes. When you made the changes, what has not been changed. So if anybody was to come in and test the period of time before the changes, you can say, okay, at this date I made the changes. And now I'm taxing or I'm not taxing, whatever that change was. So the auditor doesn't inflate the assessment because of lack of records. So always keep a good audit trail of what you're doing. So if you go in and change your records, as long as they're accurate, we probably won't have any problem with you. Is if we see about 80% taxable, or 80, 85, 90% taxable, you probably won't get a letter from us unless there's something really wrong with your ABT records.
94%, 96% non-taxable.
96% non-taxable?
94% taxable.
94% taxable. If you're running 94% taxable and you're reporting everything that you have,
Yeah.
you probably won't see a visit from us. If that's what's on your...
I know, but now I come to know that our energy drink,
Our energy.
something,
Yep.
are non-taxable, so I'm going to change.
Right. And so you still should be running about 85 to
Still in
90%.
a range.
If you're doing 95% now, you'll probably go to 94%.
94, 90.
Yeah, it's not going to change significantly. Okay? What else we got? Anybody else?
Chips, all chips is non-taxable.
All chips are basically our snack foods. We do not tax snack foods. Okay? Anything that's basically a grocery item, which would be your snack foods and so forth. Granola bars are snack foods. Your chocolate covered whey bars, those are exempt. Snack foods are exempt items. So we're not going to be taxing that. If you have any prepared foods on the premises, if you prepared foods on the premises, those are all going to be taxable. If you have any sandwiches, if you sell sandwiches of any kind, as long as it's not a frozen one, sold normally in a frozen state, sandwiches are going to be all taxable, whether you make them on premises or not make them on premises. Okay? A lot of taxpayers don't understand that, and they'll say, they'll go by what the old law was. Old law, I'm talking about 15 years ago. They'll say, hey, we didn't make it here, so therefore it's exempt. Well, no, the statute has changed in the last 15 years. It is taxable. It says all sandwiches are taxable. So anything prepared on premises, anything that is sold that's not in its original container. So if you take something out of a container, I don't know how many people may have a deli counter along with the rest of the stuff, and you sell pints of coleslaw or pints of potato salad, where you dip it out of a 5-gallon bucket into a 1-pint container. If you're doing that, that 1-pint container is taxable, even if you did not make it on premises. So those are the kind of things you want to keep an eye on. Anything else? That's it?
Does the frozen food have any category?
Does a frozen food have any category? If you have frozen foods, most likely they're going to be exempt, except when you get to your novelty ice cream products. Your
So-
frozen yogurt, frozen ice cream, your
So
popsicles.
sandwich comes in a frozen food, that's a non-taxable.
If it normally is sold in a frozen state. Now, what kind of sandwich would you normally have in a
Like,
frozen state?
The burgers and stuff comes in a frozen.
what's that?
Burgers?
Yeah, you got burgers that come in a frozen state, the little Bubba burgers, right?
Yes.
Little Bubba burgers are come in a frozen state. If they're frozen state, then it's going to be exempt. Okay? Now, just because a cooler got too cold, somebody turned it down too cold and happens to freeze the sandwiches, well, no, that doesn't work. We're looking at what normally happens. If your cooler breaks down and your Bubba burgers thaw out and you want to sell them real quick, okay, you still want to make some profit, so you're going to get rid of them real quick. Just because they happen to be thawed, we're not going to tax them, okay? We're going to look at the normal state of things. It's kind of like in my class we talked about yogurt. Everybody knows what Go-Gurt is? You got kids, you know what Go-Gurt is. Kids love frozen Go-Gurt, right? So some people, when they go in the store, they want to keep the kids silent. They don't want that kid screaming, so what they do is they go over and get a Go-Gurt, a bunch of them, and they open it up and feed the kid while they're going around the store. And they give them the box and they scan it at the end of the store. The stores found out the kids like frozen Go-Gurt. So what they did is they put some of it in the freezer aisle and some of it over in the yogurt aisle. Well, the yogurt's going to be taxable, or the yogurt aisle is going to be taxable, and what's frozen is going to be exempt. Or, well, the opposite. The frozen one's going to be taxable. What's over in the yogurt aisle is going to be exempt, right? No. It's how it's normally sold. Go-Gurt is normally not sold frozen. It just so happened they put some over there. So we're looking at how it's normally sold. Because it's got one SKU code. Can you imagine trying to keep track of what's frozen and not frozen with the same SKU code? You can't do it if you're scanning stuff, all right? And you don't want people to be able to change that at the register, right? Because that's part of your internal controls. So we look at normally where it's sold for. Candy's kind of the same way. If your candy items, what we normally look at is candy item if it's normally sold with the candy stuff. If you have a chocolate-covered cookie, we used to tax chocolate-covered cookies all the time as candy. because chocolate and chocolate things were considered candies. So we were taxing chocolate-covered cookies. Well, chocolate-covered cookies are sold with the rest of the cookies, so we basically say, hey, if it's sold with the rest of the cookies, we're not going to tax it. If we have a chocolate-covered cookie up at the front, can anybody think of a chocolate-covered cookie that's sold all the time at the front with the rest of the candies? Little Twix bars? Yeah, little Twix. What is that? It's basically a chocolate-covered wafer. Okay? Chocolate-covered wafer. Little Debbie's nutty bars? Basically a chocolate-covered wafer. What's the difference? Well, one's sold with the cookies, the other one's sold with the candies. So we're looking at where it normally is sold, how is it normally advertised and held out to be. The Twix are sold and advertised as a candy, where the other one is sold as a cookie. Now there's some states that have basically drawn the line for candy. If it contains a flour and a flour product, it's going to be considered a bakery product item and going to be exempt. The state has not done that. Okay, we're looking at doing some things like that, but we have not gotten there yet. So it's still where it's being sold from is what we're looking for. Any other questions? This has been very pleasant to talk to you guys.
We thank you too, because it's a good learning lesson for us also.
Well, I'm glad you learned a lot from it.
Yep.
He's got my information. He can hand it out. My name is Kurt Horton, C-U-R-T, Horton, H-O-R-T-O-N. Put a dot between those at floridarevenue.com. That would be my email address. Anybody that ever wants to get a hold of me, get a hold of me through my email address. If you try and call me, I'm usually not in the office. I'm usually out doing something else other than being in the office. I don't like sitting around behind a desk. I'd rather, if I'm working at home, just sitting on the chair. But anyway, you guys are taping this. I shouldn't say that, right?